welcome to April. It's that first Thursday of the month. It's time for Cup of Joe, and spring is officially sprung here in Chicago, although the weather says otherwise. It's about 40 degrees outside, but I guess that's a good sign of Chicago springtime. Welcome to Cup of Joe. As I said, we do this the first Thursday of every month. I'm Mike Carrazzo, the content manager here at Ryerson, and joined as always by Nick Webb, our director of risk management, commodities hedging. Nick, how's it going?
Mike, I'm doing great. And I'm afraid you might have jinxed it because last I looked out my window, we were getting hail down here in downtown.
Oh boy. All right. Well, hey, it's opening day for baseball, so they expect nothing else.
Perfect.
And we're going to be joined by a special guest today, Elizabeth Efta. Elizabeth, welcome to Cup of Joe.
Thanks for having me. Happy Thursday, everyone.
Yeah, and so as always, Nick's going to go through what's the latest and greatest in the commodities. Elizabeth is our expert on the logistics market. There's a lot going on with freight these days, so I thought it'd be a great time to invite her on. But first, a few housekeeping. The button down at the bottom there, Q&A. Send us a question, and we will answer it. We try to answer it along the way. If not, we'll try to get to all the questions at the end. And the full Cup of Joe will be available on YouTube starting tomorrow. And I did want to give a quick plug for in between Cup of Joes. We now have a thing called Shot of Espresso, which is a very short version of Cup of Joe, playing off of Cup of Joe because we like puns. We just published one about debunking some myths around oil and gas. Kevin Beery, our in-house expert on the oil and gas market, gave some really good perspectives. All attendees of Cup of Joe should receive that a few weeks back. If not, it is live on our YouTube channel. We're going to try to do that when timely topics come up. So just be on the lookout for that. So without further ado, Nick, I'm going to hand it over to you.
Awesome. Thanks, Mike. And yeah, I will reiterate and double down what you had said about the cup of espresso. It's really a very well done, I would say, a primer on the current energy dynamics. So I'm actually, because of that having taken place over the last couple of weeks, I'll be spending a little less time looking at the energy markets because I think that one does a really good job of diving into the main issues, both as it relates to energy itself and also as it relates to the metal that goes into the energy industry. So again, my portion on the energy side will be a little more redacted this time around. But with that being said, as we normally do, we have to go through our safe harbor provision. These are the opinions of Nick Webb, Mike Carrazzo, and Elizabeth Efta. They're not the opinions of Ryerson. You know, we're doing our best to get you the best information that we have access to, but we recommend you do your own research. This is not investment advice. We may on occasion make forward-looking statements, but these are the opinions of the three of us. So let's go ahead and hop into it. So Elizabeth, welcome.
Thanks for having me.
Yeah, no, I don't think the audience is quite ready for it yet. It's pretty rare when you get a podcast or a webcast with not just one Buckeye, but two Ohio State Buckeyes on the webinar. So welcome. I'm going to go ahead and kick it over to yourself to talk about the current freight dynamics.
Great. Well, it's wonderful to be here. I know there's a lot going on in the freight market, which is why you guys wanted me to come on. And really, I want to start with what are the 5 factors that are really influencing the market and what we have to pay for freight and what capacity looks like right now. So I think the easiest one to start with, all of these are interconnected, is probably equipment availability. So, most of us and most of our customers are in the manufacturing sector, and we all know how difficult getting equipment can be. So tractors and trailers have very long lead times, just generally, just like any new car would. Currently, tractors and trailers have an even more extended lead time. If you think about that, you want to go buy a new personal vehicle, we all know that there's chip shortages and other commodities that are causing us to have a shortage of personal vehicles. Same thing is happening on the commercial vehicle side. So when we go out and we need to replenish, whether that's our fleet or our carriers' fleets, they need new tractors, new trailers, and those lead times have been pushed out. We're looking at now, if I place an order today, it's about 18 months. Historically, that's been in about 6 months. Same thing with a personal vehicle, you're looking at months. I think my mom just ordered a new car, it's 4 months out. So we're seeing those same delays in equipment availability, which then obviously impacts capacity in the market, because if you don't have new equipment, it also is pushing used equipment up, just like used vehicles are going up. So that's going to cause some impact on your freight prices. Obviously, that's then also tied to inventory. So if people are having a hard time getting components in, whether that's in manufacturing or on the consumer goods side, we all know, and I think you guys have talked about it on Cup of Joe, all of the long lead times coming in from Asia and other imports. Well, we kind of pushed through that in the last 2 years. We've seen huge lead times, vessels sitting off of LA. People have kind of overcorrected, and inventory levels are a lot higher because people didn't want to run out of inventory. That means that we're sitting on inventory now in the US, maybe not the inventory we want, but we're sitting on it. And so we don't need to be moving things around in the same way that we used to. Also, inflation is impacting inventory. So we're all feeling that in our pockets as prices are going up. We're spending less on consumer goods, which means that those inventories that are sitting there are going to continue to sit there because people aren't buying as much. So that's impacting what's going to be used and what needs to be distributed throughout the domestic network. Same thing with fuel prices. Fuel is going to start to continue to eat into people's spending, and that's going to impact the discretionary spending on those consumer goods, those inventories, and not wanting to spend money because you're putting expensive fuel into that vehicle that you've waited 6 to 18 months to get. So fuel prices are going to push things up. I think this week we are at $5.15 for diesel here in the Chicago market, which is 62% higher than where we were sitting last year at this time. So that's having a huge impact on the market. Additionally, driver shortages. I mean, I think we've been talking about this. I've been in logistics for 20 years. Driver shortages have been something that we've been talking about for the last 2 decades. And this is going to continue. You know, there was a recent article this week about not talking about drivers in the same way we do about as a commodity. We've got to think about how are we getting people in those seats, just like how are we getting people to work in our manufacturing sites, right? And Nick, you and I earlier today were talking about that Walmart just announced they're going to pay $100,000 a year to new drivers. These are drivers with no experience. So if we think about all the drivers we have on the road, that's kind of the entry point now to get people into wanting to drive a truck. It's not cool, it's not techie, you're not in an office. You've really got to put the hours in, and we've got to continue to pay people to get those drivers in the seats behind our trucks and getting metal out the door to our customers and across the entire domestic network.
Hey, Elizabeth, correct me if I'm wrong, but during the COVID around 2020, wasn't one of the contributing factors to the driver shortage that folks just weren't able to get certified and on the road? I mean, is that still an issue? There's a backlog there, or is it mostly the employment picture?
So we are hopefully kind of coming out of that, but you're right, Mike. During COVID, if you think about it, how do we learn how to drive, or how do we even learn how to drive a truck for that matter? You've got to be in the cab with another person. And due to COVID restrictions in a lot of states, driving schools were closed and unable to train drivers. In other states, the entire CDL process was shut down because the state government didn't have in-person driving tests. So not only were we not training drivers, there was no way for us to license drivers. We're starting to come out of that. And we're also starting to see a lot of trucking and larger trucking programs and technical colleges start to have training programs in schools for drivers, because this is a known shortage. And the pay is going into 6 figures in a lot of markets. So it's something that if people want to get into it, we've got to train them and have the ability to get them on the road and licensed.
Elizabeth, you and I were also talking a little bit this morning about just sort of the impact that the Amazon effect is having on the freight market in total, or the driver market in total. Could you speak a little bit to that just for the audience as well?
Yeah, of course. So this is kind of also tied to inventories and making sure that those consumer goods are in the right place. Large consumer goods companies like Amazon, Target, other people that have huge distribution networks are willing to pay just to have captive capacity. So if you think about all of the different types of Amazon warehouses that there are, and then the movement of goods that needs to happen between all of those, in order for that package to end up on your door, if you order it this morning, you can probably get it tonight in Chicago and other markets the next day or 2 days out, right? But you've got to have a lot of drivers to do that, and they're willing to pay what they can to make sure that there's a driver sitting there in order for that to move when they need it. That means maybe they've got 100 drivers lined up to work on a Monday. They may only need 80, but they're going to pay a minimum for those extra 20 just to be available in case they need those 20 drivers to get that freight out the door and service their customers to the expectation that we all have that I order it from Amazon, I'm going to get it today or tomorrow.
Got it. So it's basically just making the competitive landscape for the manufacturing side of things that much more difficult, right?
Right. I mean, we're on the manufacturing side, it's the B2B side. We're all competing for the same drivers, and there's actually a lot of drivers that are also moving from a commercial CDL environment over to those smaller trucks, delivering packages, making those door deliveries, because it's not as labor intensive. Yes, they're getting in and out of the vehicle, but they're not on the road overnight for 8 to 10 days at a time. They're home every night, out making deliveries and then back. So
got it.
So all of those impacts, there's some pluses and some minuses, and I think what we're starting to see is that inflation, these inventories, and the fuel prices are really starting to have an impact on where the freight market is going. So we saw huge dips in 2020 during the start of COVID, where all but essential businesses were closed. We weren't out, had the same manufacturing and demands that we have now. Grocery had huge demands, other consumers had huge demands, but not the same that what we saw in 2019, for instance. So we look at a couple of things in the freight market to kind of judge that. There's a few indexes we use, one being CAS index, which is one of the largest freight audit companies in the globe. They do millions of freight audit bills every month for their customers, so they can look and see how many shipments are there and what are people paying. And then we also have dat.com, which is a little anachronistic because it's dialatrucker.com, but that's where all of this information is coming from. And this is not behind a paywall. So anyone on this call can go to dat.com, go to the trend lines and see what I'm showing here. And it gets updated every single week, and then on a month-over-month basis. So this shows us two things. Where are the spot rates and what is the load to truck ratio? And the load to truck ratio is really what is the capacity versus demand in the market. So this one is really the most important to understand, where should prices be going, right? So if there's more loads than trucks, prices should, and the spot rates should be going up. As that ratio gets smaller and loads per truck go down, we should also start to see some weakening in the spot market. So we've really started to see on the van side and also on the reefer side, which I didn't include in this slide, that load to truck ratio is really starting to come down both year over year and then also month over month. We have not started to see that as much in the flatbed side. And there's a couple reasons for that. One is we are in produce season. And as we need to start getting goods from Texas, Southern California, out to the rest of the US, a lot of that moves on flatbeds. And then we're starting to enter into build and construction season for those of us in places like Chicago, where it was hailing earlier today. As the weather starts to get better, we've got to start to move buildings goods. Those also traditionally move on flatbeds. So what we're expecting is that the flatbed market will start to follow the softening that the van and the reefer market have already seen later in Q2 and into the second half of Q of the year, of 2022. So hopefully things will start to soften up. But if we think about freight is very cyclical, and we are still higher than where we were in 2018, which is the last time that we had a tight market, even on the van side. So things are still relatively high to what we're kind of used to in the last 5 years or so. But compared to the last 12 months, we're starting to see some easing.
Great information. Hey, Elizabeth, got one question for you. Speaking of congestion and tightness in markets, we've spent a couple cup of joes talking about port congestion and things like that for the international freight markets. And the one that always gets all the headlines is the port outside of Los Angeles. Could you speak a little bit about how that dynamic is maybe shifting to different ports, or how you're seeing that evolve?
Yeah, so things are starting to clear out the congestion in LA, which was also having an impact on the van market, because we had to move all those containers from LA to wherever we needed to consume them in the US. One of the things though, just like we were talking about inventory and overcorrecting and bringing things in, people started to move their supply chains from coming in on the West Coast, LA, Long Beach, and move that over to the East Coast. So as we switched those supply chains over to, say, Savannah and Charleston, the port of Charleston is really getting overwhelmed right now. Those ports are much smaller. They have a lot smaller workforces. And here in the US, we still unload most container ships using a longshoreman and a crane. We're not as automated as ports in Asia and in Europe. So that congestion, it's easing in the West, but it's starting to really grow and ramp up in the East. So again, overcorrection, which we do all the time in every market, right? Same thing is happening here. And we're starting to see vessels line up and really see longer and longer wait times to get unloaded, especially in Charleston.
Great, thanks for that. Mike, do you have anything else before we hop into the macro side of things?
Yeah, there's one question that came in from the audience, Elizabeth, in reference to the van numbers you have here. Is that, you talked a little bit about the flatbed, but looking at the van load to truck ratios, is this typical, or is there something else impacting this that we don't see typically?
Yeah, so the flatbed, it's always seasonal that in Q2 we see things tighten up. I would say in the van market, we see tightening in Q4, easing in Q1, but to see this much easing at the end of Q1, early in Q2, is really more indicative of those things we talked about earlier. Inflation, inventories, consumer spending down, not needing to move as many goods around the US, so demand is going down. So this is less seasonality and more speaking to the other macroeconomic influences.
Okay,
what a phenomenal segue into the macroeconomic side of things.
I did that on purpose.
The one other question that came in here, any predictions on easing due to reshoring supply chains?
Yeah, I mean, I really am focused on domestically here now. I think there's going to be short term some congestion as we move freight out of the Southeast because of what's going on in Charleston and Savannah. So those rates are going to continue to be high, just like we saw off the West Coast earlier, second half of 21 and even the beginning of January rates were pretty high. But I think once we get through that correction, we should be back to lower freight rates, closer to, I don't even know what normal is anymore, because what is it? But certainly not to the highs that we've been seeing over 2021.
And I love the Cup of Joe audience because they kind of get warmed up with some light questions, and then they get there's one that I don't know how much insight you'd have into, but do you have any insights on the labor agreement with the union longshoremen in the West Coast?
I do not. Luckily, I've not been having to pay. I used to have to pay attention to that a lot more when I was bringing a lot of containers in from Asia, but luckily that's someone else's responsibility here.
Yeah, Mike, that may be one that we can follow up afterwards with either Jeff
Yes.
Pence on our international procurement side, or perhaps a freight forwarder, something like that.
Absolutely.
Excellent. Well, Elizabeth, thank you for this information. This is great. We're going to ask for you to sit tight, kind of hang on the line till we finish up the presentation, because there may be some additional questions at the end for you that I may deflect over to you. But with that said, we're going to hop over to the macro side of things, and then we'll hop into each one of the individual metals. So first things first, we got to touch on the PMI data. And I do want to highlight one thing before I hop into the additional slides that I have on the macro side. Most of the other slides I have on the macro environment are going to sound pretty darn negative. You may start calling me Dr. Doom again. You may say sky is falling. I want to highlight and emphasize the fact that when we look at this chart for both Europe and for North America, manufacturing data still looks quite strong. You can see that in the coloration of the data over on the far right-hand side. Many of the data points within Europe and the United States are in the mid-50s, which is suggestive again of year-over-year growth. And this is year-over-year growth on an already more difficult base. We're no longer comparing to a COVID year, we're comparing to 2021. That being said, got to highlight a couple quick things. One, obviously Russia is having a tough go of it right now. They've softened pretty dramatically for obvious reasons within the manufacturing side. Looking a little higher on the table, kind of top right corner, emerging markets and China have both taken a hit. Emerging markets, I would argue, is because if you take a step back and you think about some of the things that Elizabeth commented on, inflation tends to hit, lower income economies, emerging market economies, before it hits the developed economy. So yeah, maybe we're seeing a little bit of a precursor to what we ultimately see in North America and Europe, but it's certainly biting within the emerging markets. And one of those emerging markets is ultimately going to be China, who is additionally experiencing issues with regards to COVID again. Whether we like it or not, China is going through a scenario whereby they've got roughly 70 million citizens on full-on lockdown. So we're talking a big reversion back to basically 2 years ago, where Shanghai, Shenzhen, a couple other large cities are in full lockdown right now. That's impacting, manufacturing activity. Obviously, it's impacting demand on one side. For Elizabeth and the logistics world, it's obviously going to have impacts on the movement of goods out of that country or even into that country. So I would expect a lot of these bottlenecks to rear their head again. The ones that we hoped were behind us, unfortunately, just are not with regards to China. But again, keep in mind, emphasis on North America and Europe is that manufacturing activity, as we see it right now, and I would say even looking forward a quarter or two at least, is looking pretty strong. And many of the conversations I have with customers suggest that even though we are seeing, rampant inflation, most backlogs are still well intact. Not a whole lot of cancellations or anything like that, but we are keeping an eye on that. We've talked about this slide in the past, but ultimately, I'll kind of breeze through it. But ultimately, the idea is commodity markets, whether it's agricultural markets, energy markets, or metals markets, as you can see on the left-hand side, they were roaring, they were soaring for the better part of 2 years, even before Russia invaded Ukraine. Fast forward to where we are now, all of that tightness is now exacerbated. And that's because Russia and Ukraine are very commodity centric. They export a large quantity of those commodities. So anytime there are sanctions or self-imposed restrictions on buying any of that product, it's just further tightening all of these markets. Again, I don't want to belabor the point too much, but anytime those tensions are escalating, you can expect that to be have a positive impact to the price of commodities. And the reverse is also true, that if you saw those tensions de-escalate, you could see the price of commodities head the other way. This one is pretty fresh, but I mentioned I'd talk very briefly about the energy side of things. It is worth noting that in the last week or two, the United States did announce that we are going to release 1 million barrels per day for the next 6 months. So call it 180 million barrels of crude oil is coming out of the Strategic Petroleum Reserve. Now, this is very fluid, very fresh, but over on the right-hand side, the International Energy Administration, the IEA, similarly announced that many of our allies are also going to release stockpiles from their strategic reserves. You can see the actual numbers over on the right-hand side, and I will admit that the United States number is a little bit of double counting. So in reality, we already knew about the US SPR release. So you almost have to take that 60 million out because that's being double counted there. But nonetheless, we're seeing a little bit of an easing in the price of crude oil. And I think we'll see a little bit of an easing as it feeds through to diesel fuel here in the coming weeks, just on the fact that a lot of these releases are at least signaling that the administrations are trying to better supply the markets. Now, I also think that part of the reason why we're seeing energy prices lower is also because China, as I mentioned, is in a pretty stringent lockdown, and that's impacting demand as well. That one is going to be a little more temporary, in my opinion, that if and when they reopen their economy again, whether that happens in a week or a couple months, that demand likely comes back and perhaps even comes back with a lot of accommodation on the financial side. But as we take a step back and look at Europe and the United States, while manufacturing activity still looks pretty good, the part that doesn't look very good is the inflation data. Here in the US, the blue line, you can see that we're seeing some of the most difficult inflation, or the highest inflation that we've seen since the 1970s, the Jimmy Carter era. And if you have any friends, or if there are any European colleagues on the call today, our heart goes out to you, because what we're experiencing here with regards to inflation is about doubly as bad. This is the the producer price index. So this is maybe more of a wholesale type look at inflation. US is running close to 15%. Germany, as shown here in this chart, but it's really all of Europe, is running close to 25 to 30% at this stage. So part of that rationale is because, one, I would argue Europe is just a little less energy secure than what the United States and North America is. And secondarily, maybe the more obvious reason is because geographically, and I've got the map behind me, I'm not going to point it out, but they are located closer from a proximity standpoint to Russia and Ukraine. So a lot of the reliances for commoditized goods, or just things in general, as it relates to Russia and Ukraine, is much more emphasized within Europe. So anything that's biting here in the US is biting much harder within Europe. And with that, I promise I won't be too negative on this one, but over the last week, this has gotten a number of headlines. And this is, I got to give a little bit of color on what we're looking at here. The blue line is looking at the 10-year treasury yield, and it's comparing it to the 2-year treasury yield. If we think about what that means is, if you were out buying government debt, normally if you're taking counterparty risk to a government for a longer period of time, normally you would expect to get compensated a higher rate of return to do so. Conversely, you would expect a lower rate of return if you're taking a shorter duration of counterparty risk to the government. So in a normal market, you would expect the spread between the 10-year yield and the 2-year yield to be positive. That's in a normal market environment. As many of you have probably seen, there's been a lot of talk about interest rate increases, which does impact the front end of the curve. In other words, 1-month LIBOR all the way out to 2-year, 5-year interest rates. And even the 30-year mortgage rate is now very quickly, in the last 2 months, it's up about 200 basis points from 3% to about 5%. Now, that's a very lengthy description in saying we watch the yield curve as a potential proxy for how traders and how people are viewing the state of the economy, because there are points in time when the longer term economic prospects maybe don't look as good to the market. The 10-year yield can move below the 2-year yield. We call that an inversion of the yield curve. And you can see that does on occasion happen. And unfortunately, when that happens, it often is viewed as a recession indicator with a fairly decently long lead time. So I'm not saying sky is falling in 2022. I'm not saying, you need to go and sell out of all of your equities and go to cash. Normally, when this happens, historically going back to the 1970s, the inversion of the yield curve has led a technical recession, which is 2 straight quarters of negative GDP growth, by about 15 to 24 months. So again, not at all saying that it has to happen, but if we assume this relationship maintains, we could see a scenario whereby, come 2023, maybe even into 2024, we could start to see some softness in GDP data. And I think as we circle back to everything that Elizabeth talked about and some of the things that I've touched on, there is a growing concern in the market that at some point, if we continue to see inflation ratcheting up and up and up, and the consumer actually gets pinched on their own incomes, and they have a lesser ability to pay for things, the one way to fix that is to have demand destruction, unfortunately. So again, I think I mentioned this at the onset, we aren't seeing a ton of demand destruction or cancellations of orders at this stage, but I think it's something that certainly we want to have on our horizon. And when you take it into context of this chart, certainly something that we keep an eye on here at Ryerson. I think our customers should as well. Now, with all that said, getting into the actual metals markets, I first want to touch on stainless, which has been a bit of a mess over the last month. You can see that very clearly here within this 1-year nickel chart. And again, I got to do a little bit of education or a little bit of story time on what happened within the nickel market over the last month or so. As we understand it, and some of this is a little bit of hearsay, but it's for the most part looking like it's true. So I'm going to kind of tell the story, and then we can obviously take Q&A at the end on any deeper dive questions one might have. As we understand it, one trader, which is arguably Glencore, the world's biggest commodity trader, they took a long position in nickel. Whether were doing that for speculative reasons or for hedging reasons, we don't know, but they had a very large position that represented about 50 to 70% of the physical inventories that existed on the London Metal Exchange. On the other side of the trade, we understand Tsingshan, which this has gotten a lot of press. Tsingshan, which is the world's biggest stainless steel maker, they had a short position, meaning they were hedging themselves or protecting the downside risk of nickel prices dropping. They had a short position on about 200,000 metric tons, and the pricing was somewhere around $10 a pound. When the market starts to rally and you have a large short position, and again, I don't want to insult anybody's intelligence, but given a little bit of color on what's happening, you can get what's called a short squeeze, where if you're short and the market runs up, your risk is basically infinite because the price of nickel can go as high as it wants. You're not bound by the price of zero the way you would be in the opposite scenario. So it can cause some panic. And if you've got 200,000 tons of nickel short, which is worth a lot of money, that liability on those financial positions can get very large very quickly. And about 3.5 weeks ago, the price of nickel jumped 250% to about $50 a pound. Now you're probably looking at this chart saying, wait, if it went to $50 a pound, why am I not seeing this on the chart? Well, the reason why you're not seeing it on the chart is because behind the scenes, as the market was ripping to $50 a pound roughly, that liability position for one company got as large as $15 billion. It could have been, that liability position may have perhaps been larger than the company Tsingshan itself. So long story short, there's perhaps no way for Tsingshan or for their banks to cover that kind of liability position. So what the London Metal Exchange did is they said, we're going to stop trading. They halted trading, and they actually did something that's fairly unprecedented, which is they canceled about 8 hours worth of trades, which were all the trades that were taking place between $22 a pound and $50 a pound. And what they did was they artificially set the price down at $22 per pound. And I can tell you that there were a lot of traders who were extremely upset about this because they were long this metal, and they believed that they were owed millions and millions of dollars by either the exchange or from their bank. And so fast forward to where we are today, what's transpired? Well, you've got the London Metal Exchange that's put trading limits on each side of the market. So you've got a 15% gain or loss limit on how much the exchange can now go. And that's not just true in the case of nickel. That's true in the case of all the other base metals on the exchange as well. And as we fast forward today, you can see that when the market reopened, the exchange went limit down, limit down, limit down, until we got around $12.5 per pound. Since then, the market's been extremely choppy. There's been a general lack of liquidity, which just means there's been a lack of trading interest in the market. And so that really kind of gives an idea of what we're seeing within this space. And I've got a little more here in just a couple of slides. This is the exchange inventory on the London Metal Exchange. So this is actually the volume in metric tons that exists within the warehouse system of the London Metal Exchange. As I mentioned at the onset, there are about 74,000 metric tons on the exchange. Half of that roughly was cornered by one counterparty. So in essence, you basically had somebody who kind of gamed or controlled the system on the long side of the equation. That part is not fully unprecedented. This actually did happen back in the 1980s in the tin market. A Japanese trading company called Sumitomo actually cornered the tin market. A short squeeze occurred then, and the London Metal Exchange was actually forced to close the exchange on tin trading for about 5 years. So obviously we're not seeing the nickel market closed for 5 years. We're seeing it more like 2 or 3 weeks. But I think the cancellation of the trades really irked some people in the marketplace, because that's a fairly unprecedented thing. And then lastly, as we look at, I mentioned the fact that there's less liquidity in nickel now, and that's causing a lot of this extreme volatility in the nickel space. This chart gives you an idea of that. It's called open interest, which basically means the number of open and active transactions that exist on the LME nickel contract. You can see that as soon as that squeeze occurred, the open interest in the contract fell off like a rock. Now, what is that represented? I think it's probably one of two things, if not both. One, that's probably representative of Tsingshan getting out of their short positions, actually liquidating their trades by buying back the short positions that they had on the books. That then basically takes those volumes off from an open interest standpoint. And then I think secondarily, as I mentioned, you've got a lot of very angry traders who were long nickel and believed that they were owed millions and millions of dollars. Some of those traders are now saying, I'm never trading in the nickel market. I'm never trading on the LME ever again. And they're basically taking their ball and going to different markets. So the LME has certainly lost some credibility in this situation. And I think the jury is still out on how we progress in this situation. As it relates to stainless, because I know many of you are actually buyers of stainless, you're not buyers of nickel. So we have to kind of address the elephant in the room, which is what happens to stainless pricing. Well, each mill is kind of approaching it in a different way. North American Stainless, for instance, I'll pull up the nickel chart again. They basically ignored all of the short squeeze prices. So any of the trades that took place post that big short squeeze, they pulled them out of their calculation, and they basically artificially set the price of the surcharge for April shipments down at $12.60. Now, going forward, at least for now, it's my understanding that they are going to go back to the exchange mechanism and honor the LME pricing, which unfortunately, if we use the market pricing today, which is roughly 1530, that would increase 304 prices, 316 prices by roughly 15 to 17% just from the nickel move itself. So as long as the mills continue to adhere to the LME nickel market and we continue to see it price around where it is today, that's likely going to mean further and higher surcharges in the coming months. As we think about other possibilities that could happen, because I think we really have a disconnect between what the London Metal Exchange is and what it's intending, or what it was intended to do for the marketplace. Because as we think about it, the London Metal Exchange and these warehouse inventories that I'm showing here on this chart, those represent refined nickel. So this is like 99.9% pure nickel content. As many of you on the call may know, the nickel that goes into stainless steel, the nickel that goes into lithium ion batteries for electric vehicle production, it doesn't have to be refined nickel. So in a lot of ways, you have this instance where nickel is not nickel is not nickel. The nickel that is accepted on the exchange, which is actually mandated to be a certain purity, is not the same necessarily kind of nickel that goes into the production of the physical goods that move around the world. So you've got this situation where one little situation, which is 74,000 metric tons of refined nickel, is all of a sudden having knock-on effects to the price of buying an electric vehicle, the price of buying stainless steel. And I don't think that was ever the intent to have that kind of disconnect. So there's a chance that the LME nickel contract goes away. And I don't necessarily think that's going to happen in the next month or two, but it's certainly a risk. And because you can make the argument that perhaps the North American stainless mills should be pricing off of stainless scrap because that's how they produce it. But we'll have to wait and see. So I don't mean to be too hyperbolic about it, but the nickel market, and as it relates to the stainless market, is a bit of a mess right now. For all intents and purposes, it's kind of broken as we sit here today. And there are a lot of traders and participants within the space who are, like I said, taking their ball and going home and leaving the market behind.
And Nick, you brought up, I think a few questions came up during that segment, and then you kind of ran into all the answers. One of them being any thoughts on using stainless scrap instead of nickel to calculate the surcharge, which you just answered, and then about LME maybe shifting to a more neutral exchange. But so yeah, definitely a hot topic. And I should mention this all happened, I think, the day after last month's Cup Joe, right? Yeah. So like the information we put out, it was the next day just kind of blew up.
Yeah, I mean, I do not envy the CEO of the London Metal Exchange right now. I would guess he has not slept a whole lot in the last couple of weeks. But a lot of money is on the line, a lot of credibility is on the line. But yeah, all those questions are very valid, which, the LME, as I mentioned, there are certified brands. And when I said brands, basically makers of the nickel, certain regions and obviously certain purity that is accepted on the exchange. And that's just not a good representation of the physical market anymore. Our CEO actually last week made a funny comment where he said, basically Tsingshan, the stuff they were shorting, or in other words, the stuff that they used to produce stainless steel, it was basically like Tsingshan had 1 million tons of hamburger, but everybody at the party wanted steak. They are similar, but if the exchange doesn't accept the other one, then there's no real fungibility between the two types of products.
So Nick, I'm sorry, I don't mean to park you there for a second, but where do you see stainless prices then headed maybe in the next 6 to 12 months?
I mean, if we get back to fundamentals and the markets can trade and operate in a normal fashion, I tend to be of the opinion that nickel prices will revert back down into a more normalized range, which I call normalized range, looking at this chart, somewhere in, let's call it around $12 a pound, 10 to $12 a pound, I think would make fundamental sense to me, because a lot of nickel miners around the world can make plenty of money at those types of prices. It's actually the reason why Tsingshan, who is a nickel miner themselves, it's why they had short positions on in the first place, because they were hedging their forecasted production, and then they knew they could make money at those types of price levels. So I think if you ignored the gamesmanship and the trading dynamics of what's taken place over the last month, I think that would be a natural place for us to go, which would actually feed through to a lower surcharge. So I'm only talking about the surcharge. I'm not talking about base prices from the stainless mills. But unfortunately, we have a situation right now where I think there's less liquidity in the markets, less volume taking place. So getting good price discovery in the market is certainly more difficult right now. And my analyst and I actually got a note just a little bit ago that said some of the banks are even revisiting whether or not they even want to participate in offering hedges and trading in the nickel market in general, which that's not going to help liquidity either. So again, it just comes back to this theme of it's a bit of a mess right now. But I don't think behind the scenes, if I'm a stainless mill, yeah, prices going up is a good thing for a bit, but prices going up too far and in a very erratic fashion, again, coming back to this demand destruction theme, you could see some issues with that. So I don't think the stainless mills really want a ton of, volatile pricing, particularly to the upside, because that could end up leading to some demand destruction within the stainless world. I'm going to breeze through the aluminum side, not because I'm not interested in aluminum, but to be honest, relative to the other markets, it's kind of boring. Over the last month or two, we've actually seen prices come off their record highs a little bit. We're still very elevated. And as we look at this chart relative to the moving averages, the 200-day moving average, the 100-day moving average, and the 50-day moving average, we're very much so still in a bullish uptrend. Momentum is still strong for now. You can see we're trading above all those levels. But there really isn't a ton of news to talk about within the primary ingot side of things. On the alumina side of things, which is the raw ingredient going into the production of aluminum, as we've talked about in prior couple of Joes, and as we've seen, as you can see in this chart back in 2017, 2018, one of the big producers of alumina is Rusal. Back when there were sanctions in 17, 18, you can see the volatility that happened to the price of alumina. We are seeing some volatility. There's no doubt about it. We are seeing some volatility in the price of alumina on this sanction risk to alumina and potentially aluminum, but certainly not to the extent that we saw back in 17 and 18. I think part of that reason is just because, one is China going into lockdowns is a little bit of a blessing in disguise because it's dampened the demand impact of the overall aluminum demand equation. So that's helped to soften a little bit of the blow. Now, when they reopen, yeah, that probably does spark on a little bit more on the demand side. But for now, we're actually already seeing a little bit of a retracement in the price of alumina. And I think we've looked at this chart in the past, but this looks at the money manager position. So this is basically traders, hedge funds, things like that, and how they're positioned with regards to aluminum. Anything below zero would be a bearish position or a short position. Anything above zero would be indicative of a long position. It may not look like a whole lot because admittedly, the long positions on amongst hedge funds and traders is still very high, but I don't think we should ignore this little blip lower in the last couple of weeks. I think part of that is going to be due to the fact that China's gone into lockdowns. So that takes a little bit of the bullish side of the equation out. I think secondarily, part of this move lower could again be related to the nickel market, where not only did traders walk away from the nickel market, there's a chance traders walked away from the whole London Metal Exchange just because they were so angry at the situation. So I don't have proof to verify that, but I think there's a chance it could be related both to the lockdowns as well as to the anger at the LME. A little bit of bad news on the flip side. While we are seeing some softness in the ingot price, Midwest premiums are at record highs, and they've held up around the 40 cent per pound level for the better part of a couple of weeks at this point. Part of that's due to tightness in physical product. Part of that's due to the fact, which Elizabeth talked about quite a bit, which is just tightness in the trucking and logistics markets. So whether it's the port issues or the trucking issues domestically, getting ingot into the Midwestern portion of the United States is more difficult and more expensive than it's been in history because these are record high levels. Now, flipping over to the carbon side, we were obviously seeing carbon prices come off like a rock. We talked for the last several months about this, that the price of hot roll, as we're showing here in this chart, actually sold off faster than it even ran up, which is pretty crazy to say. We went from about $19.50 per ton all the way down below $1,000 per ton. Well, we're not there anymore. So what happened? Well, I think I mentioned this on the last call, but the United States imports about 3% of Russian and Ukrainian material. So it's a fairly low percentage. So why would we see prices spike? Well, Europe is in a very different scenario. Europe has an import penetration of material from that region that amounts to about a third of their overall volumes. So as soon, again, given this close proximity to that region, Europe just has much stronger linkages and exposures to the commodities of those regions than we do. So almost instantaneously when the invasion happened, things like pig iron, things like scrap, And obviously the availability of steel became much more difficult and much more expensive for the Europeans. And you can see the price in Europe spiked a couple weeks before the United States, and it spiked in a big way by about $500 per short ton. Now, as we think about the knock-on effects to the United States, well, if the price of Europe is going up by $500 and the US is a net importer of steel, well, all of a sudden, that next incremental ton that we may have to buy to fill our demand situation, it's just gone up by 40 or 50%. So almost instantaneously, you saw a lot of the domestic mills hike prices by several $100s, and many of those for now are sticking. So I would say that really is the crux of what's occurred, is just the next best set of pricing in the global market has gone up by 50%. So it'd beholden the US mills to say, we got to take prices higher too. And you can see US prices quickly went from about $950 all the way up to about $1,500 a ton. It's interesting because you look down at China, and China continues to not have these same issues. Obviously, we can't buy Chinese material direct because it's got tariffs and duties on it of several %. But it's amazing, all of these situations that are happening within Europe and within North America, they just aren't happening within China right now. And yeah, it's an interesting dynamic for sure. And then maybe secondarily, the other factor that has had an impact to a lesser degree, I would argue, would be the price of scrap, which is shown, busheling scrap is shown in the blue line, and then the white line is going to be iron ore. Both of those markets have rallied fairly substantially. Iron ore even rallied prior to the Russia-Ukraine situation. But all of that being said, I think it's important to note that even with scrap currently sitting up around $800 a ton, if you come back to that normal equation of steel mills being okay with kind of a $250 to $300 spread, $800 scrap kind of puts your hot roll price at $1,100. We're obviously well in excess of that. And I think that's just because we've got European prices that are also well in excess of that. So your next best good place to find steel just got 40 or 50% more expensive. A little bit of good news to leave you with on the carbon side of things before we hop over to Q&A. This is the historical futures curves. The blue line being 6 months ago, you can see the trajectory was massively down, which we did actually see transpire. The green line is as of a month ago, so basically the last time we all spoke. And it was actually forecasting a little bit of what we've seen in the last 3-4 weeks. If anything, it slightly undershot how far we're ultimately, or how high we're ultimately going with regards to price. But the good news is, as we look here at the orange line, there is a little bit of downward slope in the current futures curve, which, as we think about what the futures market represents, it is a best guess look into where traders think the futures price or the future price of steel is going to be. And as we sit here today, traders are basically saying, yeah, we'll see elevated prices relative to where we were 2-3 months ago, but there could be a little bit of a cooling off effect as we roll through time. And I think part of that is explained by the fact that, the spike in Europe may perhaps be temporary. If we rewound to 3-4 years ago and asked the question, is the world short steel? Everyone and their brother would say, not at all. China's overproducing. And that's why we put tariffs on China in the first place. Not that much has changed here today, but I do think it takes a period of time for Europe to rework its supply chains. And what I mean by that is, about a week ago, Europe, for the first time ever, actually bought carbon slabs from China. So they're basically using that as a raw substrate to re-roll and make their own steel from Chinese substrate. So I think there are some things taking place that are just kind of reworkings of the supply chains that will eventually cause things to hit a little bit of a headwind on the rally, and then maybe things can subside a little bit. So that's at least what the futures market is suggesting at this point in time. And with that, we will take some Q&A if we have any.
Nick, what's the latest on capacity utilization? We haven't touched on that in a while. How's that looking these days?
Yeah, it has been a bit. As we sit here right now, the official capacity utilization percentage is right around 80%. It's actually just a touch below that. So I would say that's fairly standard. So I would say with regards to, operations, they aren't running too hot, but I wouldn't say there's panic producing either. So it's a fairly standard range, around 80%.
Elizabeth, as we look at the logistics market for the remainder of the year, you obviously outlined those 5 factors that we should keep a close eye on. But what are generally, I mean, as we head into summer, does it change with any kind of seasonality there? Or are there other factors we should be looking at, or does it stay pretty with those 5 factors you outlined? I guess the outlook for logistics.
Yeah, I mean, those are the 5 things that are kind of unique to this year. In general, we've got some periods of seasonality that tend to happen in a normal year. Didn't necessarily happen as much in 2020 with COVID, but generally we start to see imports from Asia ramp up in the late summer as we start back to school, bringing in goods for clothes for kids, back to school items, and then that continues to ramp up through the fall as we head into holiday season. That then tends to kind of taper off between, we'll call it Thanksgiving and Christmas on the international side, but that's really where we have hit a peak with domestic trucking. And then things generally tend to kind of go off in January, taper down, and then again on the import side, ramp up with Lunar New Year. So there are some generalities in the freight market that we have as it relates to seasonal activity. But I would think as folks are bringing new equipment in, which even with those new lead times, one of the reasons they're so far out is people are holding artificially build slots. So as people bring that in, capacity will start to loosen. Hopefully we're filling those seats with drivers and there's someone out there moving those goods. The forecast is that pricing and capacity should go up, pricing should come down, and there should be some easing, even with those normal seasonal events like back to school and then the holidays.
And Nick, back to the there's a question here about there's a chart you had, the inflation rate between US and Germany. Why is the current inflation rates between these two so different from the historical trends that you show on the chart?
Yeah, sure. I mean, I think, and again, it is worth noting that the chart that I pulled up was PPI, not CPI. So that's the producer price index, not the consumer price index. I would say most economists, that the big headline number you would see most often is CPI. So I will admit I pulled that a little bit because I thought it more extremely showed the inflation, but the PPI data is arguably a leading indicator because it's actually coming from more of the wholesale or upstream side of the supply chain. Why is it so out of whack? I mean, we could probably spend an entire afternoon talking about this, but it's everything from demand is running incredibly hot still on a global basis, ex China, who's currently in lockdown. We've had trillions and trillions of dollars printed over the last 2 years, which is, not to say that it's wrong to have printed that amount of money, but it certainly caused markets to run a bit hotter than they certainly would have without that money. Equity markets are quite high, which makes those who have, money in the markets have a bit more to spend. And then just the general breakdowns of supply chains has caused the availability of things to get more difficult and more expensive. All those factors thrown into the blender causes things to move in a very asynchronistic way.
Makes sense. Well, very informative, jam-packed session here. We're right up against it. I'd like to turn it over for closing thoughts to Elizabeth and Nick. But before I do so, thank you again, everybody. I know there's a million things you could be doing, but joining us every Thursday, 2:30 Central, 3:30 Eastern, for Cup of Joe. And as always, this full recording will be available on the Ryerson YouTube channel starting tomorrow, as well as small clips for different segments broken out by the logistics segment. Obviously, a lot of informative stuff on stainless. And without further ado, I'll turn it over to both Elizabeth and Nick for some closing thoughts.
Elizabeth, go ahead.
Yeah, so I mean, I think it's important to remember, just like any other commodity, logistics, freight is a commodity, it's cyclical, and there tend to be booms and busts, and we're definitely in a boom right now for the freight carrier side. And as we shippers want to start taking over, it looks like we're plateauing on freight rates, and we should start to see some of that flip back over to us. But definitely right now, carriers have all the leverage, and we've just got to do what we can to make sure that we can get our goods delivered. So hopefully, all indicators are pointing that there'll be some easing in the second half of the year, and hopefully those come to fruition. So thanks for having me today.
Thank you, Elizabeth. Great information today. And yeah, I think the message for this month would be, we are in many ways seeing a continuation of the same with regards to difficulty of getting goods and obviously the inflation of goods, which is impacting the pricing of many of the metals that we sell to our customers. So certainly want to send a thanks out to all of our customers for being patient with us, for working with us. This is not a Ryerson phenomenon. This is an everybody phenomenon. But at least as far as I can tell, availability of product coming out of Ryerson, even given all of this turbulence, should still be well intact. If you've got any concerns about availability, I highly recommend you reach out to your sales rep and have those conversations, because forecasts from the demand side are still quite good, and we're doing everything we can to make sure we don't stock out our customers, even though we are seeing higher prices at the moment. So thank you, everybody. Thanks for your patience. And one of these days, this craziness will come back down to earth, and we won't spend an hour on these types of things. But thank you, and looking forward to next month.
Thank you all.